Hey everyone, it's Friday and we are back for another episode of the 6-5 podcast. I'm your host today with my super smart, handsome, vest wearing podcast partner, Mr. Patrick Moorhead. I was going to try to do a pickle pepper thing and I failed miserably, but it is episode 153 and there is a lot going on today. Patrick, how goes it for you?
I am doing great. Thanks for asking. A little bit spicy today, as we discussed in the green room. It's been a very productive week. A lot of stuff coming out. People still pretty much asking about the impacts of the economy and what's going on. But I'm glad to be here. This is my favorite thing to do on a Friday.
It is my favorite. It's been a big week. There's been a lot of earnings this week. There's been some good news this week. We got some economic data in this week. After kind of a fast, furious technological start, CES, NRF, lots of kind of early in the year product announcements and momentum. We've hit that kind of end of the month where that crazy earnings palooza. You and I kind of always joke like, we don't love doing earnings, but it is kind of the ground truth moment. And, as of 2 years ago, it was all up, 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 up. And now it feels like everything's down, 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 down. But you know what? It wasn't all bad. Some of the companies did quite well. So we'll talk more about that today. We've got a action-packed show. We're going to be talking about Salesforce and an activist investor. We're talking about Microsoft and OpenAI's deepening partnership. Then we're going to hit earnings, Microsoft, SAP, Intel, and IBM. And we're going to talk a little bit about what maybe the market should be, how they should be thinking about what's happened in the past week. If this is the first time watching our show, the 6-5 is all about analysis, light on news, deep on analysis, 6 topics, 5 minutes each. We love our community. So I'll ask you now and I'll ask you at the end, hit that subscribe button. But I do have to give that little disclaimer, especially this week when we do talk about a lot of earnings. This show is for information and entertainment purposes only. So while we will be talking about publicly traded companies, please do not take anything we say here as investment advice. In fact, as Patrick always likes to say, do the opposite. All right. So rock and roll. Pat, why don't I call your number first? Let's talk about Elliott management storming the doors at Salesforce.
Yeah, so Dan, for the past couple of years, you and I have talked on and off about activist investors taking big stakes in companies that they think they can run a play on. And for those who don't do a lot of investing, essentially an activist investor looks at a potential victim of somebody that they think they can come in and buy a certain piece of the company, which gives them rights to either suggest to bring in a new board, make a lot of changes, get into a proxy battle. Elliott management is a big one. Starboard is a big one as well. And this week, activist investor Elliott management joined Starboard in targeting Salesforce to go after, essentially to get them to do things, and then the stock goes up and then they sell. That is the grift. So really kind of got me thinking, if you look at, again, we're not equity analysts, we're industry analysts. Over the past year, Salesforce stock is down 22%. Now, a lot of other stock is down. 5 years, the stock is up 50%. But I do think that people have the right to question, let's say, organic growth versus acquisitions that the company has made, like Slack as an example. And I think, my recommendation to Salesforce is first and foremost, don't over rotate on this. They came in. It's interesting. Elliott wrote this love note to Benioff that they did publicly, talking about how much they respect him, what a great company he has built, and how they followed him for so long. And I don't know, I think that's typically just BS, just to show that, hey, we're not going to be hostile. We're going to start nice. before doing a complete broadside on you. And it's important that Salesforce and Mark Benioff don't under-rotate either and ignore it, because what happens is companies like Starboard and Elliott, they start to raise the heat over time, right? We've seen this at Apple, we've seen this at Qualcomm, we've seen this at Intel, we've seen this at a bunch of other companies. So I'm going to be watching this very closely about how this rolls out. Salesforce is an easy target right now, right? Where you had the co-CEOs in play. You've had multiple senior executives stand down. That 25% growth rate that just seemed like guaranteed went down to 14, is expected to go down to 9%. Mark Benioff spends a lot of time in the limelight that's not necessarily tech. So it's going to be interesting to watch.
I think the last several months have been refocus months for a lot of companies, and we're in a refocus period for Salesforce. The company did a lot of inorganic growth. It's well documented. You and I both published some various pieces about this. I think they made some good acquisitions. Companies like Tableau were a very strategic acquisition in a world where data and the ability to visualize data is going to be paramount in the long term. The company's been very sort of siloed in how it's told its story: Service Cloud, Sales Cloud, Marketing Cloud. And I think what's happening is there's sort of these capillaries that need to run between the veins and arteries. And it's going to be one of these moments where the company needs to sort of retell its story again as a more horizontal story and not in these kind of silos. Elliott coming in, I'm not sure how much value it really adds to the company right now, but I do think it's a reminder that even the companies that look the most stable and like you said, consistent growth, can very quickly become targets of an activist. But I think if you look at an Elliott, this is a much sort of longer term safe play. And I know that they're going to try to make this move in the short term, but I think it's going to take a few quarters. The math is pretty simple to me. You've got workforce reductions everywhere. Salesforce is a subscription service in most cases, which means less people working, less seats. It's going to be harder to show growth. So they're not only growing against a slowing, but they're growing against actually having reduction in utilization of their subscriptions. And then now you're going to have to see those people added back. Now, just like semiconductors go through troughs and peaks, you're going to see a similar thing here. We're seeing workforce reductions. We're waiting for the Fed to cut rates. When the Fed starts cutting rates, stocks are going to go up. Companies are going to start hiring fast. Growth is going to come back to the economy, and SaaS numbers are going to go up. Salesforce has more competition. There's more SaaS out there. There's more cloud-based solutions out there. So they're going to, of course, be under some level of pressure. But I actually think the acquisitions they made could bear fruit. But that's up to them to make it happen. Slack, for instance, for the last 2 years, I've been advising, you got to tell a better story. Microsoft Teams is going to eat your lunch. Here's a better approach to it. They're listening, but there's been a lot of turnover, a lot of change, new leadership in the Slack group, and they haven't quite gotten Slack first to be Slack first. But I do think people like using Slack. And just like people like using Slack, people don't always love using Teams. So while Teams has 280 million users, it doesn't take a huge chunk of market share to be won over by Salesforce to make a difference. Elliott will put some pressure on Mark Benioff, but I don't see him as the type that's going to cede a lot of power or control to an activist investor. He's built the company to a very, very sturdy and stable point. The market largely does respect him. And if he does, to your point, Pat, get back in the chair and show that he now without Brett Taylor, now without Stuart Butterfield, is willing to lead the company the way a company needs to be led, I think he can get it back on the right track. So
yeah, there's been a lot of folks who have kind of bounced back. Michael Dell, right, quote unquote, retired and then came back to take the helm. We've seen, Steve Jobs came back. I would even say Larry
goes in and out.
Has he actually gone out though?
Not really, but he certainly seeded a lot. He hired 2 CEOs to not be running the company. But what I'm saying is, whenever it gets tough over there, he suddenly shows up again with a new concept, a new idea, and he reinvigorates his audience and his customer base, and off they run. I think Mark will probably be fine. Actually, I'm certain of it. So, Yep, I think some good analysis there, Pat. Let's dive into another big piece of news before we kind of get to the earnings run here on the show, and that's the Microsoft OpenAI. So we all kind of had heard about the $10 billion investment that was planned for Microsoft in OpenAI, and so that one kind of deepened this week. Pulling up some notes here. I've got a research note that I'm finally going to get published. It took me a little while, but they basically finally announced that the partnership has been expanded. And what does this really mean? Well, what it really means is that Microsoft not only is investing the $10 billion, but it's looking at giving a lot of, it's looking to democratize. I think, as you know, every company on the planet is using some Microsoft software. Whether you're running Windows, whether you're using Office, it's pretty much pervasive. Well, OpenAI and its potential is really in its earliest days. We're hearing a lot about ChatGPT, and ChatGPT is interesting and powerful. There's a lot of ethics and use rights and content rights that need to be explored further, especially in using it in the open domain. Interestingly, Pat, my daughter came home, and I guess it's a whole ethics thing now in the high schools, because guess what kids immediately started doing when ChatGPT came out is they're all cheating on everything. And the bottom line is it is pretty much an enabler, but just as fast as they're able to learn to cheat, there will be AI tools set to help catch them to cheat on different things. But long and short is there's a much bigger and more opportunistic part of the partnership with Microsoft and OpenAI. And that's the more democratization of the OpenAI technology throughout the Microsoft portfolio, which is the Microsoft advantage. And then, of course, how this could potentially translate to other tools and technologies in the Microsoft ecosystem. Microsoft, some of the first things they're looking at doing is supercomputing at scale. They're looking at creating kind of AI powered experience, what they call it in the Azure AI, OpenAI services. It'll go across the portfolio. And then, of course, this is the big Microsoft moment. That's going to be the exclusivity of its cloud partnership, which means OpenAI will be running in how many clouds, Pat? One cloud. Sorry, I just felt so cool to do that. I was kind of like getting your crowd when you go on stage.
I'll also see if I'm paying attention. I get it.
No, were you paying attention? Because I'm really interested. So anyways, a couple of interesting things that I've been thinking about. I think we talked about this, Pat, a couple weeks ago, but is the real opportunity for OpenAI is going to be in the proprietary data. So bottom line is we're already seeing with what people are doing with ChatGPT and say, I want to write a ethics paper at a 10th grade honors student level. That's done. We figured it out. It can do it to some extent. As more data becomes available that it's able to scrape across the web, it'll keep doing it better. But companies have masses of proprietary data, the data that comes off vehicles, smart city data, the data that lives in our ERP systems, the data that lives inside of our sales data, CX tools. That's proprietary and unique. So if companies can start to use a tool like OpenAI to rapidly be able to implement meaningful customer journeys, or more intelligently understand customer behaviors, or being able to better understand safety profiles inside of municipalities. That's going to be a really unique opportunity where OpenAI, as opposed to really extensive and complex data pipelines, become more usable. So I look at this as a kind of a democratization of AI as a whole, but also a very thoughtful investment from Microsoft, because the exclusivity on Azure is obviously going to create a ton of demand for Azure services. And coming off Microsoft's relatively tough earnings this quarter, which you'll talk about here coming straight out of this topic, this is kind of what I call a silver lining to what people are saying is slowing growth in the cloud, because with this partnership and all the AI that could be done across the Microsoft portfolio and the way they account for cloud, Pat, this should be a way to accelerate their cloud growth coming into the next several quarters.
Yeah, this story gets more interesting. And, I don't know if it's brilliant communications people, but you and I have managed to talk about these two companies. I think this is our third time. So hats off on dribbling out the content to get us to do that. And, that kind of, reminds me of a tweet. I wouldn't call it battle between Jan LeCun and the founder and CEO of OpenAI, but they kind of got into it where Jan said, to be clear, I'm not criticizing OpenAI. By the way, Jan LeCun is, the most famous AI person out there right now. said, to be clear, I'm not criticizing OpenAI's work nor their claims. I'm trying to correct a perception by the public and the media who see ChatGPT as this incredibly new, innovative, and unique technological breakthrough that is far ahead of everyone else. It is just not. Now, this is kind of endemic of really, really smart people, that this notion that just because you might have thought of it first, that's where it ends. It doesn't. I mean, OpenAI and now Microsoft are just telling a bigger and better story. LLMs have been around for a while, and I'm certain that Google and AWS both are, have something in the oven. Maybe for Google, it's going to be DeepMind. Maybe it won't. But the fact is, between OpenAI and Microsoft, they're playing their A game. So what was new here? First thing was, hey, they're doubling down on supercomputer workloads, right? There were no details on which ones, but you'd have to think things like drug discovery would be out there to be able to do this even better. They said they were going to integrate it into Microsoft consumer and commercial applications and services. Absolutely no details, right? Dan, you and I will be on a fourth, fifth, or sixth time talking about what this is. But man, I'd love to see this baked into PowerPoint, baked into Word, baked into Excel. Today, Google Workspace has a lot of AI features already baked into their tools, but the ability to go with these expensive LLMs, I'm pretty excited to see what it is. Last time we talked, I'm like, hey, where's the differentiation here? Where's the moat? Well, I think there's a short-term moat that you called out, and that's their exclusive. Azure is the exclusive LLM provider for OpenAI. There was no duration that was announced. There was no money that was discussed. But again, that will be for our sixth installment of this that we can talk about. If nothing else, looking big picture, it has excited people. I mean, I don't know if this is the new NFT, like this is the big investment where everybody's going to get rich and everybody's going to get into. And, two people will make money and 1 million will lose money. But I am very positive, though, that it is
Pat,
showing a different look at what you can do with AI.
Did you lose money on a NFT scam?
I did. And I don't think it was a scam. I mean,
I'm
they were
joking.
minting
You
some
just
pretty
sound
cool
very
stuff.
bitter.
But, well, listen, I mean, all I need is one of my investments out of 10 to hit, and it will do well. But after we both got wiped out in growth last year, I was hoping maybe one would hit. But literally, I mean, the only thing I made money on this year is horses. So that's about it.
Cars, horses.
Cars. No, I mean, cars are losing value. But anyways.
I know what you mean, though. The assets you would expect to perform have not performed. So, hey, we got to keep moving here, Pat. So I'm going to call your number and going to let you build on kind of your Microsoft commentary. And that's Microsoft. Already, they kicked off the week. They sort of set the tone, and that's not uncommon.
Yeah, it was interesting. They came out, with the press release. Their stock goes up, right? They had some great stuff. People are talking about, hey, the recession is not touching. Everybody got excited. And then the call came and the stock went down. I felt a little bit like the rug was pulled out. Market Watch's Jeremy Owens warned on Twitter for people to do that. I didn't see his tweet, but I'm going to be careful next week when I'm talking about Microsoft here. I mean, here's the highlights. I mean, revenue up 2%, operating income, off 8%, net income up off 7%, EPS was off 6%. But I think there are highlights where you would expect there to be highlights. So first of all, you need to understand there are some things that companies just can't turn off, okay? And you can't just turn off using Word, PowerPoint to save money. I mean, what else are you going to do? Sure, you could go use some free service, but that's not going to work in your corporation. Office 365 was up 11%. You got a lot of people getting laid off. Where is the first place they're going to go? They're going to go to LinkedIn, right? Sessions were up 10%, record engagement. Microsoft 365 subscriptions were up 12%. Again, when it comes to something like ERP, you can't turn that off. And we're going to get into a little bit when we talk about SAP. Actually, I misspoke. Microsoft Dynamics 365 was up 21%. And what else would you expect? The PCs were down, and they were down a lot, right? Market was down 29%. Microsoft was down 19%, and that was a combination of Windows being down, 39% on OEM. Little surprised at the Surface decline of 39% because it was just so much higher than market. But I do know that Surface and Apple MacBook, those two brands go head to head, and Apple drove a lot of market share over the last quarter. Now, I left what people lead with. It seems to be the only thing that people care about related to Microsoft, and that's Azure, right? Azure was up 31%. Still awesome. They had a tough compare, though. It's down from 46% year on year, but they did slightly better than expected. One final comment that I thought was interesting that came up in the intelligent cloud portion was that energy cost increased. I don't remember seeing this in any other disclosure for a major cloud company, but makes sense, right? Energy is going up. We're cutting off certain aspects of energy. We have embargoes of energy over in Western Europe, and they've had to switch significantly to different sources, particularly around natural gas. So something that I think I'm going to be watching in the future.
Yeah, you hit a lot of it there, Pat. I mean, the energy thing is very interesting. So is FX. We've seen a little bit of a cooling in terms of the dollar, which has actually been a bit of a tailwind for these companies. It could have been worse, actually, had the dollar been stronger coming into this quarter. You look across the Microsoft, nothing about that kind of fall that came after had to do with really this quarter. This quarter's numbers were actually pretty okay, but the guidance was extremely cautious. And for Microsoft, that's a change of tune. Over the last several quarters and past few years, there really hasn't been what I would consider much of a caution in guidance. It's been generally pretty bullish. Pat, we keep hearing because we got to make a disconnect from the public equities market and the actual economy. And so remember, for a year when the market was still showing good results, stocks were falling. So Microsoft and Amazon, they were showing great growth in every quarter. And you and I, because obviously even as personal, or you look at our own portfolios and you're like, whoa, they're these great numbers, and yet they're down 30, 40, 50s. So, you look at that, and then you kind of see now when things are actually starting to get bad, most of the pundits would say, when is the recession going to really be seen? They talk about the latter part of this year is when we're going to actually measurably see more of a recession. Now, again, that's debatable because we make that political, because I think we've kind of been in one for a little while now. But you've got some certain numbers that prop up or pull down, like rents and energy, that can disproportionately make things like inflation or the economy look strong. For Microsoft, you've got, you had a 31% Azure growth, I believe it was.
That's right.
Not a bad number. You had a lot of parts of its businesses looking healthy. Dynamics 365 looked healthy. The Teams number, 280 million active monthly users now. They've absolutely taken that. They've barnstormed that industry. And that goes back to what I said about Slack and others have not been able to keep up at all. They've got the market pretty well surrounded. They're well diversified. So, it's not like they're overly rotated to consumer. Surface, when the market was screaming, didn't go up that much. And now the market's falling. I'm thinking it's probably not going to fall as hard either because, they haven't really gone full out on Surface. And there's obvious reasons with that tied to Windows. And I know, Pat, you follow that even closer than I do. So the long story long on this whole Microsoft thing is that they will bounce back. And when the economy bounces back, they will roar back. Will we have 2 or 3 quarters of slowing? Yes, it was bound to happen. And what's really funny is don't be surprised if the equity price is disconnected from the fact that Microsoft's results actually get worse. And the last thing I'll say is, remember when they grow 31% in cloud? That's 31% over a number that was 40-something% a year ago that people thought was massive. So they're growing still in mid-double digits over what was considered to be a massively good result during what's considered to be a horrible period in the market. So I don't know. I just think we've lost our mind. But let's keep going anyway.
Sage words.
You want to talk about SAP? Let's talk about SAP.
Let's talk about SAP. You want to call your dad?
Oh, Dad, can I talk about SAP? Hold on. It's for me. Dad said yes. Dad said yes. All right. So SAP, another company that kind of came out a little bit soft. Now, SAP is interesting, Pat, because they report overseas. And, you and I get the message sometime in the middle of the night. And I do sleep at night. People sometimes wonder if that's true. I do. I woke up, I looked at the number, I think the kind of the whisper number or the whisper versus, Pat, we look at those guys and say miss. It had a lot of misses. I think it had like almost all, but they were all really close. And I think that was one of the things where Wall Street's just very punitive. And so there is no close. There is no 99%. You either hit the number or you don't hit the number. And that's kind of how the market looks at it. So when you look at share price, you got to keep that in mind. But when you look at actual performance, you got to kind of look back and say, in most classes, including the hardest AP classes on the planet and the hardest collegiate classes you'll ever take, a 99 is still an A. So there's an argument to be made that what SAP did was pretty good. Now, over the last several quarters, Pat, and I'll tell you, SAP numbers are harder to parse than a lot. I find them hard. So let me tell you where I look. And where I tend to look are in a couple of places right now. There's the logical growth, revenue and profit. And of course, you're kind of looking at how is that? Well, 11% up, 5 at constant currency, gross profit up 10%, 4% at constant currency. So again, growing over what was considered to be good growth during stronger economic periods of time. They kind of do this thing where they put cloud and software together and then they parse cloud out. The software is kind of the older part of their business, but the cloud part of their business, and you and I have had a chance to talk to Christian Klein, this is the part of the business that I think investors and market and people that are kind of evaluating SAP really need to pay attention to. Cloud revenue growth, Pat, 33%. You know who grew less than 33% in the cloud? Microsoft. That's what I'm saying, and I'm not trying to be critical of Microsoft because 31 was good, but I'm saying 33%, $12 billion number in, and I believe, by the way, are these euros? I sometimes get torn. I think they're euros, but 12 billion.
Definitely not Deutschmarks.
In the cloud, and that's a 33% growth number with a 27% growth number to their cloud backlog, Pat. Yeah. So when I'm looking at these numbers, I'm saying, they're kind of growing in the right places. Now, what probably irked some people, and by the way, longer term will probably drive the share prices up, is they also announced some restructuring. Now, some companies are calling them RIFs. SAP is very clear that this isn't a RIF. This is a strategic restructuring of the business, meaning they want to put more resources and spend more dollars on things that are going to pump up their growth numbers. And if their growth is coming in the cloud, then they're making somewhat of a rotation. They're getting kind of cutting back on some areas that have maybe become lagging or slowing parts of the business to put more dollars to use into these other areas. So that's going to be something that people were kind of debating on whether it was a good or bad. Pat, across the board, and this is something, you had a great piece. We did this on the show last week about RIFs and the meanings of them. I hate any individual being hurt. And when you look at these at a micro level, you have to be inhumane to not care about people losing their jobs. But when you back off of companies that are hiring hundreds of thousands of people, it's not equilibrium of performance across the organization. It's not equilibrium of talent and skills. Companies that make decisions to try to care for everybody oftentimes, the few oftentimes really harm the everybody of an organization. So if you have to cut 3% of your workforce to reinvest in a different skill, a different talent, to be able to make sure that other 97% have jobs in the long run, are able to continue to grow in their careers, That's a decision that had to be made. By the way, Pat, that used to be done regardless of economies. Companies used to just cut 1, 2, 3, 4, 5% of their workforce every year because they needed to get the lowest performers out and bring the high performers in. There was a time when I don't think that was scrutinized. There was books written about it, about what a great strategy that is. Somewhere in between lies the truth. Last number that I think we pay attention to, and that's the share of more predictable revenue. Almost 80% of what SAP does is predictable. At the size and scale and scope they are, that's pretty damn good. When you know 80% or so of your revenue, Oracle has a similar number. That's a really nice, predictable way. Now, the things you got to criticize, the earnings per share way down, operating profits are falling. This is what they're dealing with the restructuring. I think we give them a couple of quarters to come back, but we want to watch that cloud growth. That's the long-term health of SAP.
Good analysis, Dan. I don't understand why the market is reacting like it is. That's one reason why I'm an industry analyst, not an equities analyst. I mean, if I look at Oracle, ServiceNow, Microsoft, and Adobe, all up over 5 days, you've got SAP that's down 2%. And with that cloud growth looking really good, I did talk to a few people that said that some of the financial analysts had used a currency conversion that was there 3 months ago. And so it's just a complete confusing mess to me. So what I need to do is I need to go back and look at the company kind of holistically and its value propositions. If you noticed, they spent, you still there, Dan?
Yep.
If you notice, they spent most of their time spending about 20 the entire year. In fact, it was hard for me to find what they actually did just in the quarter. And I kind of had to go back and look at their website in real time. I mean, it was hard to figure out actually what happened. One of the biggest announcement was that they said they were going to divest itself of Qualtrics. And maybe that had to do with the funny stock price right now, given how much SaaS companies are getting hammered. Maybe that's what's going on. But their operating expenses will go down, and that should be good. And then when you tie this with the rebalancing of the workforce or the layoffs, that should be good for the stock. But I'm really interested to see what the company's going to do with the cash that they get. Are they going to make smaller acquisitions? You know, what are they going to do with it? Are they going to give it back as dividends? What I'd love for them to do is double down in what they're doing is investing in these small companies, these small cap, even startup companies, kind of like an innovation fund out there. So 33% cloud revenue improvement over the year, 27% increase in the backlog for cloud over 2022, and a pretty good fourth quarter, all said.
Yeah, I do want to throw in one comment. When you labeled off the other companies that were up for the week, and I obviously do a little bit of work with ServiceNow, so I want to disclose that. But that company beat and raised across the board. It beat on earnings. So, frankly, I think companies that accomplish that probably have a warrant justification to go up. But by the way, that hasn't been consistent. But that was one that I just noticed. Like they actually did beat and raise despite this macro condition.
How about Oracle,
others,
Microsoft, and Adobe?
What's that? Those don't make sense. That's why I said like the others. Your others were right on. Those two didn't make as much sense to me. Adobe didn't report, so they're just getting they're just some sort of indirect impact. But obviously, so ServiceNow has had a really good quarter, so that hopefully would be the driver. Even though their PE ratio is like 400, I'm not kidding, it's huge. All right, let's go on, Pat. We got 2 more to go. We got 15 minutes left of the show. Calling out Intel. This was one that required Pepto.
This one, Intel had a very tough quarter. So I'm probably going to spend less time in the quarter and more time on long term. But listen, they were. Let me pull up my notes here. They were down big time. I mean, they missed on every single number expectations except for the revenue number for data center and AI, lovingly referred to as DCAI. Revenue is down 32%. Gross margin was down 14 points. Net income off 92%. EPS off 92%. The guide was 40% lower than what they did previously, and their stock, as you would expect, got hammered. So, a couple things going on here. First of all, you've got a mixture, a confluence of things going on at the same time. And one thing I want to lead by saying is these semiconductor turnarounds take years. I mean, you have design, you have manufacturing. Those could take 5 years to get. It takes 5 years from a grounds up design to turn something around. And Intel took a 3-year fab lead and put it into a 2-year lag. And this is, we had the chance, both of us talked to Pat Gelsinger yesterday, and he committed to the on track for 5 nodes in 4 years. So this quarter, mixture of macroeconomic issues. They're spending a lot of money making big investments on transformations for areas like IFS. I mean, they're going from a complete monolithic design to a complete modular design. The expense of doing 5 nodes in 4 years is gigantic. And what happens when you have a product that kicks in, it hits you hard on cost of goods sold. And the final thing is competitive pressure. AMD is taking revenue share from Intel in client and in server. Now, when I look at the gross margins, and I wish I could see the gross margins of the client business, I believe there's a price war going on, and Intel is doing a meat comp strategy, which is a big reason why their margin was literally 39%. I think it could have been lower had they not changed equipment depreciation to 3 years. So that's really all I'm going to talk about this quarter. I mean, it was not good. So you have to look at what drives a company like Intel. There's a lot of things that I use as milestones. My number one milestone right now is on their core manufacturing technology, aka nodes. So what did Intel say? Intel 4 is manufacturing ready. Intel 3 is on track, 18 and 20 angstrom. Silicon is running the fab and of a major potential foundry customer. It's a big deal. Meteor Lake, which is the first disaggregated client product for second half, and Lunar Lake on track for production readiness in 2024. Now, this is the number one. Sure, design matters, but when you're playing catch up here, what Intel is trying to do here to compete with companies like AMD and even Ampere Computing out there in the marketplace is their compute tiles are probably twice the size of what AMD's and Ampere's are. And again, I'm making these numbers up right now, but when you have larger silicon, you can't put as many cores on a package. It's just very simple. Intel is taking a bold approach. I like the approach using accelerators, but it's not nearly as easy as, let's say, what AMD and Ampere are doing. So I have not lost faith in this company moving forward. If they miss their nodes, I will have my doubts. But as long as they keep on this trajectory, I'm pretty positive. And the other thing is, I think TSMC keeps having missteps, and not missteps in process, but missteps in terms of how they're dealing here in the U.S. If IFS gets a toehold on advanced technology in the U.S., it is going to be ugly for TSMC. NVIDIA is already signed up for IFS through Ramp C in defense. You kind of know my theory here. I'll air it again that I think once China invades Taiwan, we're going to move all defense needs to be built out of the U.S. It's going to be core infrastructure, energy, healthcare, finance. Basically, the U.S. will establish the same rules that China has had in place for over 20 years for systems that have to be all China software and all China infrastructure, not necessarily the chips, because they don't do leading edge. All right, there we go.
Well, you hit most of the important stuff there, Pat, but I'll kind of add a few comments that I think. One is there was no surprise here. What happened was largely what was expected. This is a challenging period of time for Intel in the market. We all knew we were already in a semiconductor. We had the glut, and now we're going to have the pullback. We got the inventory challenges. Of course, you had the operational and the ramp issues. You had some positives this quarter with the Sapphire Rapids ramp. That looks good. It was good to see some growth from IFS, and of course, Mobileye is doing great, but they really are their own company now, so it's more of it's part of their investment portfolio, and they still own a lot of it, by the way. I think you hit it on the head, Pat. I got asked by a couple of journalists yesterday about kind of what is the turning point for Intel. And, the turning point is this 4 and 3, this very aggressive process strategy, this IDM2 that Pat Gelsinger has laid out. They've got to hit it. They got to hit it every single time. And if they hit it every single time and they deliver, they're going to get back on track for process leadership, and they're going to reinvigorate confidence in the market. But again, Pat came in with this whole say-do thing. And the thing is now he's being held to it. And so he's saying the right things, but the doing is going to take time, and seeing it happen, Pat, you said it's a multi-year turnaround. It is a multi-year turnaround. Building a fab is a multi-year process. Getting their toe in on leading edge is something I do believe they're very capable of doing. And by the way, it won't only be because Intel's doing things right. It will also be because it will be driven by policy. The policy starting with defense, but it will become more than just defense. It will be a technology leadership conversation, and it will be a resiliency conversation. A lot of people think CHIPS Act passed because of the supply chain. And realistically, the supply chain brought the CHIPS Act more into focus, but it was always about defense, was why we needed to bring more leading edge back. And Intel's the company that's best positioned to do it at scale for the leading edge. So I think long-term, there's a better outcome for the company. They still do have large market share in key markets. And if they can just get to execution consistently, I think there's a promising future. But it's going to be a couple of tough quarters, if not longer, before it's going to really show up in their numbers.
You think TSMC just is seeding the military stuff? Just saying there's no chance we would ever get that. We're just going to seed it.
They certainly don't seem to be stepping up and trying to position around it, Pat. But again, we don't know what's behind closed doors. I'm not going to proclaim to know that. But out in the market, we're not hearing from CC or anyone else about how they plan to address the concerns. So, all right, we've got one more, Pat.
Let's do this, buddy.
By the way, International Business Machines, IBM, we can end on a pretty positive note. So C. Arvind Krishna and I had the chance to talk to CFO Jim Kavanaugh on earnings day, and he gave me the run through, and it looks really good. Now, I'll be candid. It's sometimes hard when you're at flat revenue without constant currency to say good. But again, you got to remember this macro situation. It was a good result, 15.7 billion, flat actual, 6% with constant currency. And noted they beat. So they beat on revenue. They beat on guidance. I mean, near beat, but they beat the range on guidance and on earnings. And then they had pretty good guidance, mid-single digit growth to continue into the new year. Their growth was solid against all segments. And as I've said a long time, I mean, you and I got to sit down with Arvind last year. He talked about his strategy. And you know what? Nothing has really changed. His strategy has been implemented. They're heavily focused on hybrid cloud and AI. Those are areas that are doing very well. Their growth is coming from high margin areas of their business. Software and consulting is now about 75% of their portfolio. So we saw software up 8% constant currency. We saw consulting up 9% at constant currency. They're recurring now. They have almost 60 billion a year. 50% of their 60 billion a year is now recurring, Pat. They've made 8 acquisitions, so they're continuing to take advantage of the M&A landscape. There aren't big deals. They're making smart tuck-ins that help them across their portfolio. Hybrid cloud was up 17% at 22.4 billion, and now more than a third of the company's revenue is hybrid cloud. And Red Hat, continues to truck along at mid double digit, 17.5%. Could that area grow faster? It certainly is an opportunity to grow faster, but those are good, solid numbers especially within the IBM machine. Margin went up, net income went up. They're delivering great free cash flow for the company. And Arvind came out, and despite all the kind of rumors about slowing and elongated sales cycles, he actually said they're accelerating into the end of the year. So, as tough as the last one was to discuss, Pat, IBM seems to be in really pretty good shape. So you got to give Arvind a lot of credit, give Jim Kavanaugh and the team. You and I have had conversations with a lot of the executive suite across the portfolio. They're doing some restructuring. Some new people are coming in. That'll be interesting to watch. They are making some cost-cutting measures. They are lowering some headcounts. That was kind of quietly done. But when companies are hitting numbers and making those decisions, that's usually very long-term and strategic in nature. And kudos to IBM on a really solid quarter.
Yeah, man, IBM, just when you think, I love a turnaround story. And, I had a lot of people ask me, even some analysts, hey, why do you analyze IBM anymore? They're dead. They're the mainframe company, right? And here we are, 6% looks freaking good in this environment. It's durability, right? You're not going to see a 25%. In fact, what they committed to the street was single digit growth. They're doing exactly what they said. When everybody's down, they're up, right? Gross profit up 132 million, net income up nearly $500 million. Investors got a little bit spooked, I think, about the free cash flow forecast. They had $9.3 billion free cash flow for the quarter. And I'm going to put a big exclamation point and reiterate what you said. Revenue mix is over 70% software and consulting. That is freaking awesome. Okay. Now what it does do is it kind of pretends they don't have this robust hardware business than they do. In fact, IBM Z was up 21%. Hats off to Ross Morey out there. Software, ARR for their hybrid software and services is $13.3 billion. Red Hat was up double digit, up 15%. Again, isn't it funny how those numbers now look big? But it just shows how durable IBM is as a company and a technology provider. Heck, consulting had a knockout quarter, right? Revenue is $4.8 billion. Hybrid cloud revenue, $9 billion over the year. First time I think I've seen Azure and AWS got brought up. Bookings doubled. Margins were up 2% as they amortize some of the investments that they made out there. So all in all, a really good quarter. Companies doing exactly what they said, and in fact, I think outperforming a lot of the kind of high flying cloud first companies that are out there. So kudos to IBM.
And there you have it, Pat. Busy week, a lot going on, a lot of earnings. And by the way, next week, we got more of that. What are we going to have next week, Pat? I believe we have Amazon, we have Apple. I think AMD is going to go out next week.
Yeah.
Google, Alphabet. So we're going to get more of a flavor here, and I'm sure we're going to come back and hit on the rest of these. But really good show. We covered Salesforce, we covered Microsoft and OpenAI, and then, of course, hit the earnings, Microsoft, SAP, Intel, IBM. It's a big moment for technology, Pat. And in the end, we will tech our way out of whatever storm we are in right now. I do believe in that. Tech is deflationary. That it was not going to change. So anyways,
right.
Thanks all for tuning into the show this week. For Patrick and myself, we'd love for you to join our community. Hit that subscribe button. Hit those social follow buttons. If you don't follow, Pat is absolutely prolific on Twitter, and I'm not bad either. We appreciate everybody in our community, but for this show, for this week, for this episode 153, time to say goodbye. Thanks for tuning in.